Hello, good evening. Assalamu alaikum everyone. This is your tutor for Practice to Pass webinar for the ATX for September 2021. My name is Saad Mohammed and I welcome you all on behalf of ACCA. If all of you can raise your hands if they can hear me clearly. Thank you. I can see many of the students were also present yesterday as well. Good to see you again, guys. So I'll start with my introduction first. My name is Mia Saad Mohammed. I am teaching advanced taxation and advanced audit subject for the last 5 years. Apart from that, I run my own consultancy called MNSK Chartered Accountants. So as yesterday, I gave you a brief introduction of the paper, the pass rates, the reasons of the failure, and the prime reason of the ACC of conducting this webinar is to make you guys enable to pass the paper. Yeah. So the major mistakes that I discussed yesterday specifically to ATX was that the students are unable to understand the difference between the taxation exam and the advanced taxation exam. So guys, I told you yesterday that the exam, advanced taxation exam, is a planning sort of exam. You need to explain the rules here along with the numbers. Only mathematical calculations or numerical calculations will not be able to achieve a pass. So that is why you have to explain. And the pro tip I gave you or all was that focus or think that the examiner is your client and he is a layman. He does not know about the tax. So tell or explain him in detail along with the calculations. Try to make him understand what you are trying to say. If you will just provide him the calculations, being a layman, he will unable to understand that. Now, with that, I will move on to my plan of questions. Yesterday, from day one, we were unable to attempt uh, Carda and Max. So we'll start with question Carda. It is available in the Kaplan exam kit. It is the question from December 2015. You will not be able to find it on ACCA's practice to pass platform or CBE practice platform. You will not be able to find it there. But it is a very good question about few topics of IHT. That is why I've selected that question. Yesterday, I gave all of you a tip as to how to start the question, and it was start with the requirements. Now, before I start the reading the requirements, if anybody has any particular question, they can ask in the question section. So after reading the requirement, I'll go through go through your questions and I'll answer that. Meanwhile, you guys can post your questions there. Now, the first requirement is explain the inheritance tax advantages other than lifetime exemptions. So I have to be careful that it has clearly been specified that I cannot use lifetime exemptions as a tax advantage in my answer. If I will do that, it will leave a very bad impression, and more than impression, the examiner will not be giving me any marks for mentioning any lifetime exemptions. So I have to be careful that I will not be mentioning any lifetime exemptions in my answer, which could have been obtained if Kada had made additional lifetime gifts of quoted shares between 1st December 2017 and her death. So there's some person, he or she, Kada, made transfer of shares, quoted shares, and whenever I think about shares, BPR comes into my mind for IHT, but it has a certain criteria and we have to check. Then here it has asked me about the lifetime gifts as a whole, that what are the the different advantages that could have been obtained other than lifetime exemptions if she would have made the gift on certain date. Now the requirement B relates to calculate the increase in legacy to the charity which would be necessary in order for the reduced rate of IHT to apply and quantify the reduction in the inheritance tax liability which would result. So guys, I do remember that there is a reduced rate of IHT. The normal rate of IHT is 40%. However, only and only in one circumstance the rate can be reduced. And what is that rate, guys? Can anybody mention in the question, please? What is the rate? The reduced rate of IHT? Yes, thank you. You're right, 36. That is the reduced rate of IHT. And the criteria is if you leave a certain amount of your estate on your death through will to charities, you can avail this option that a reduced rate of 36% will be applied on all of your estate. Now, what is that criteria? It is called baseline amount. We will be discussing it or revising it shortly. Then the requirement C is explain the inheritance tax advantages which would be obtained by varying the terms of CARDA's will and set out the procedures required in order to achieve a tax effective variation. Now, uh, deed of variation is a very easy topic, and if you guys have an idea, you can easily score 6 very good marks by just telling the procedures first, that what is the procedure, and then can tell by reading the scenario that if they have the option to modify the will of Carda, what are the tax advantages that they would have obtained. Now, moving back to the question, as the part B relates to the reduced rate of IHT, let me take you to my notes and revise that topic. There was a student who asked in the question section that, sir, what about losses? He almost attempts the losses in every attempt. That is why I've selected two questions today in which there'll be good amount of testing of losses. And throughout the questions that I have selected from now onwards, they will test the good amount of losses as a topic in the question. Now, in my notes, you can find in the inheritance tax section, that is the first chapter there, reduce rate of IHT. Now, it will tell you that as to how you should calculate an amount called baseline amount. Baseline amount is there for the criteria or the slab that if you leave the amount of state to charity equivalent to baseline amount or more, a 36% rate will be applied. Now, the baseline amount is calculated as whatever the gross chargeable estate is, you have to deduct the nil rate band out of that and add the charitable legacies. If the R and RB is mentioned in the question and already deducted after the gross chargeable estate, you have to add that back as well. Now, whatever that amount is, you will take 10% of that, and if the amount that has been left to charity is more than 10%, then the 36% rate will be applied. For example, let's say my baseline amount is 80,000. So the 10% of baseline amount is 8,000. If I have left 10,000 charity, it means I have left more charity than the 10% of baseline amount. The 36% rate will be applicable. If I have left 6,000, I have left a lesser amount than the baseline amount, 40% normal rate will be applied onto my state. It will be more clear when we'll be doing the calculations in the question. So let's get back to the question. Your firm has asked to provide advice in connection with IHT and CGT following the death of Kada. The advice relates to the implications of making lifetime gifts, making gifts to charity, varying the terms of the will, and other aspects of CGT planning. Kada and her family. Kada, who was domiciled, died on 20th November 2021. So date of death is quite important, as if we have to do any calculations, we have to consider that date. Kada is survived by two daughters, Raymer and Yang. Raymer has an adult son. Yang has no children. Kada's lifetime gifts and available NRB. Kada had not made any lifetime gifts since 30th November 2017. Kada's NRB at the date of her death was 220. So, guys, you have to remember that the NRB that is available for the estate is 220. Do remember that during your lifetime, the NRB is available to CLTs, chargeable lifetime transfers, And at death, if there is any NRB that has been left by CLTs and PET, only that is available to your death estate. Now, Carda's death estate and the details of her will. Carda's owned assets valued at 1.1 million at the time of her death. Carda left her house valued at 600,000 to Raymer. Now, do remember, guys, that whenever in an IHT question somebody has house in their state, the residence nil rate band R and RB should come into my mind. Another criteria is that it should left to direct descendant and it is children and grandchildren only. So Carda has left a house to Raymer, which is his daughter. So that is fine. Both of the criterias are fulfilled, but that house should be the residence of that person. It should not be an investment property. For example, the people may have their own house, but they may have invested in real estate and they have two, three spare houses as an investment property. If that is the house that has been left to someone, the RNRB will not be applicable. Now, Carda has left a cash of 60,000 to a UK national charity. That's fine. We have to calculate the baseline amount for Carda and then we'll take 10%. If the 10% is lower than 60,000, then all of the estate will get the rate of 36%. Carda left her remaining assets, including portfolio of shares valued at 440,000 to Young. None of the remaining assets qualified for any inheritance tax reliefs. That's fine. Let's talk about Raymer. Is not an accountant but has some knowledge of the UK tax system and has made 4 observations regarding her mother's estate and her inheritance. My mother should have made additional lifetime gifts in her lifetime. The tax rate on the chargeable estate should be 40% due to the gift to the charity. Now, being a layman, obviously, Raymer does not have a clue that there is a baseline amount and we have to take 10% of that because he's a layman. You have to explain him that what the baseline amount is and is the 10% is lower than 60,000 or not, or is the 36% rate applicable. You can clearly see he does not know what is the reduced rate of IHT. He just said that the rate should have been less than 40%, and that's how clients are. Okay, so that is what I'm keep telling you, that you have to explain the clients considering that they are layman. So you not only have to explain him that what is the reduced rate of IHT, but you also have to explain him the criteria. And for that, obviously, you should know it yourself first to explain it to someone. My mother paid. Okay, I do not intend to live in the house, but will give it to my son on 1st July 2022. One thing I always say that it is always better that if the children are wealthy and they don't need the gifts, they should directly be transferred to the grandchildren. Why? Because what it does is it saves the IHT of one generation. For example, if Mr. A will give something to his son first. It will be a pet. And if Mr. A dies within 7 years, his son has to pay IHT on that pet. Obviously, the taper relief will be available provided he manages to survive more than 3 years. And if then Mr. A's son gift the same thing to his own son and he dies within 7 years, this thing will again be taxed. So isn't it better that skip Mr. A's son and Mr. A should transfer something he wants to transfer directly to his grandchildren or grandchild? What it will do is it will skip one generation and it will skip the IHT of one generation as well. So before I move on, it was a bit tricky point. I want all of you to raise hands who have understood as to how it skips the tax of one generation if you transfer something directly to your grandchildren. Raise your hands if you have understood. Okay, guys, thank you. So moving on, he said, my mother paid capital gains tax every year. However, when she died, some of her shareholdings had a value less than cost. Now, yesterday we have already discussed that in IHT there is a relief called fall in value relief. Similar relief is available in CGT as well. It's called the negligible value claim. We'll discuss it later on. But it is available for the items that you have, but they have, their value has been decreased. For example, assume for the example purposes, assume that I have an asset whose value is 100,000. I haven't sold it, but its value is now 40,000. So what I can do is, even without selling, I can claim the loss of it from HMRC. You guys will be like, sir, what if its value will increase in the future? Obviously, for future purposes, your cost will not be 100,000, rather 40,000. So let's say after a few years, its values gets back to 100 and even more than 100, you have to pay capital gains tax on that because you have claimed losses from HMRC. So, uh, Carda's shareholding at the time of her death. So he has quoted shares in JW PLC valued more than cost. Say they would have been subject to inheritance tax because they were valued more than cost. But there were shares in FR PLC that were less than cost and unquoted shares that were valued at nil. So the last two items didn't had any increase in the value or any benefit that has been obtained. So for them the criteria will be different, and for the first one the criteria will be different. Now let's move on to the requirement, and it was asking that what are the advantages. If I normally discuss with you guys that, if obviously there is one big advantage of making lifetime transfer, that you are eligible for lifetime exemptions like annual exemption, marriage exemption, small gift exemption, uh, exemptions like that. But what are the exemptions other than these, or what are the benefits other than these that one can obtain by making a lifetime transfer? Can any, yeah, you guys can post your answer into the question section. What are the advantages that one can obtain by making more lifetime transfers? Anyone? Rasha, yes, you're right. Taper relief. Obviously, if you make more lifetime gifts, if you manage to live more than 3 years after making the gifts, the taper relief will be available. Uh, Guys, a few of you have said fallen value or annual exemption. Fallen value will only be available if the asset has fallen in value, but it is not an advantage. Yesterday we have discussed, for example, I have something that has a value of 80,000, but at the time of death its value has decreased to 40,000, so I can claim fallen value relief. And if this item has directly been inherited to me on death and not been transferred on lifetime, I will directly inherit on 40,000. So there is no difference of loss making items, either they are transferred to you on lifetime or through death directly. So fallen value is wrong, and annual exemption is a lifetime exemption, so it is wrong as well. Only the taper relief till now is the correct answer, and it is one of the advantages that if you make more lifetime gifts, there are chances that if you manage to live more than 3 years, you'll be able to claim taper relief. That is one advantage. Any other advantage? Yes, Amal. We can say that if he manages to live more than 7 years, it will be exempt altogether. Yes, it can be an advantage as well. Uh, Then yes, Nabil, you're right. NRB. All of you who are saying annual exemption, your answer is wrong. Annual exemption is a lifetime exemption. It has been clearly mentioned in the exam, in the requirement, that other than lifetime exemption. So we cannot say annual exemption. Okay. I was talking about Nabil's answer, NRB. Yes, NRB is right. Guys, you know that NRB gets to renew after every 7 years. For example, if there is a transfer that has used RNRB, or sorry, NRB, then after 7 years, that transfer will become exempt and it will no longer will be constituted as using NRB. Fahim said RNRB. Sorry, Fahim, this is a wrong answer. RNRB is only available at death. So there is no difference. and RNRB is only available on residents, so it cannot constitute as an advantage. Two advantages I have found from your answer: one is taper relief, one is NRB, availability of NRB. There is one very easy advantage which you guys are missing, and that is the value increase. If anybody transfers something in their lifetime, its value gets locked, and any increase in the value after that date is not subject to IHT. For example, if somebody has transferred something to someone and its value was 10,000 at the time of transfer, and he died within 5 years, let's say, so the person has to pay the tax on the value on the date of transfer, not on the value of death. So let's say if the value on the date of transfer was 10,000 and now it's worth 15,000 today. So he has to pay the tax on 10,000 and he can claim taper relief as well. So the value increase in value after the date of transfer is not subject to IHT. That is one of the very big advantage of making much more lifetime gifts. So I have to explain the advantages for 4 marks. I guess three advantages are more than enough. Now, yes, Rakesh, obviously there is no risk in the decrease in the value as well, because if there will be decrease, you will claim fall in value relief. So you should make as much lifetime transfers as you can, because uh, if you manage to live more than 7 years, exempt altogether. After 3 to 7 years, taper relief, and they will the increase in value will not subject to IHT. Uh, Osama, I doubt that we can mention BPR, because BPR is also available on death, because the person to whom the item has been transferred has to keep that till the date of death. We have discussed that yesterday as well. So it is usually available at the time of death. Now, in the second, calculate the increase in legacy to the charity which would be necessary in order for the reduced rate of IHT. First of all, I have to first check that what is the baseline amount as per the CARDA's estate. So it it's mentioned the total here already, that her estate is 1.1 million. So the house that has left is 60,000, and the nil rate band that was left is 220. What I can do is, considering the state is 1.1 million and it is slightly changed from the data is slightly changed from the question from the data in Kaplan kit. In Kaplan kit, you will find the estate value to 1 million. So I'll use 1 million here for you guys as well. Let's assume the state is 1 million rather than 1.1 million. So the NRB that is available at the date of death is 220. So 1 million minus 220,000, 780,000. But even before deducting the NRB, the first thing that you deduct is always charities. So I will deduct the amount of charities first from this amount. It's 940. After deducting charities, the estate that we have is called gross chargeable estate, GCE. That is what it is called. Out of 1 million, all I have deducted is charities. Then I will deduct the NRB of 220,000. It's 720. So 720 is my estate, but what was my formula? Let me get back to the notes to calculate the base amount. Take the gross chargeable amount, deduct the NRB from that, and add back the charitable legacies. So let me solve this question on Excel for you as well. As I told you that it is not available on the practice platform, so I'm using spreadsheet installed on my computer. So this column I dedicate to the description, and then I can make this column for this state. Here I will insert the symbol of pound. It's your choice. Even if you don't do that, it doesn't matter. So this is my estate, that is, and I'll select the format here. 1 million is my estate less charities. It's 60,000. So my gross chargeable estate will be equals to sign, as I taught you yesterday to use the formulas, but it's your choice. These are not necessary. I found it comfortable because if there is any figure that I have missed, I can always insert and the formula will update the answer itself. So that's my gross chargeable estate. Do remember that NRB is always gets deducted after gross chargeable estate is calculated. So the charity is first in the order and then the NRB. So NRB is 220,000. So my taxable estate is this 720,000 is my taxable estate. Now I now have to calculate baseline amount to check that what rate needs to be applied on this 720. If the amount of charity is more than 10% of the baseline amount, 36%. If not, then 40%. So let's calculate baseline amount. For baseline amount, the criteria is you have to take your GCE, means gross chargeable estate, and our gross chargeable estate is 940,000. You have to add charity in that and less NRB. So charities were 60,000 and NRB was 220,000. So baseline is equals to this plus this and plus this as well, because plus minus will automatically will become minus. So guys, this is my baseline amount. Obviously the 10% will be equals to this times 10%, 78,000. Now guys, you tell me, CARDA has made charity of 60,000. So the baseline 10% of baseline amount is 78,000. What rate will be applicable? Tell me in the question section. 40%, 40% or not? 40% or 36%? Quick. 40%. Why? Because the charity needs to be higher than the 10% of baseline amount. Yes, Yusuf, you're right. Needs to increase the charity. Now, that is fine. I know now that the IHT will be at 40%. 40%. So what will be my IHT? This answer times 40%. It will be 288,000. Now guys, tell me, am I missing anything? Yes, Rajab, you are right. What about R and RB? We haven't taken R and RB anywhere in the calculation, and that is why I have uh, left this column. Now I can less R and RB here as well. And what is the amount of R and RB for our tax here? Can anybody tell me? 175,000. Thank you. Why I haven't added back R and RB in gross chargeable estate as per my notes? Let me take you to my notes. If the question in the question the data has been given to you that the from gross chargeable estate, the RNRB is already deducted, then you have to add it back. If not, then what you can do is just not deduct the RNRB. What I have done here, for example, I have calculated chargeable estate, my gross chargeable estate myself. It was not given to me in the question. So I then added back charity and less NRB, and I haven't taken RNRB here in the calculation and here. So it nullifies the effects anyways. So make it simpler, take gross chargeable estate, add charity in that, less RNRB, and it will calculate baseline amount for you. So now to update my answer, I will update the formula of chargeable estate, and that is deduct these two amounts, and then it will automatically takes 40% of that. Now, guys, have I missed anything? Okay, for people who can't see my figures clearly, I have zoom in my screen. Okay, thank you. Now, guys, it has also asked me, let me get back to the requirement. It has not only asked me to calculate the tax IHT liability, but has also asked me that to quantify the reduction, that how much charity she needs to make in order to qualify for the reduced rate. And guys, we can easily tell that by looking at our calculation. You tell me what is the amount that would have been made as a charity to claim the 36%. What is the amount, guys? Obviously, anything equal to 78 or more will attract lower IHT liability. So we will take 78,000 exact because it will do the same. So obviously for that I can copy this figure here, and rather than deducting, or what we can do is we can copy all of this data to here, and we can just change the figures we want to. We can insert a column in between just to separate those. Okay, now here rather than 60 I will change it to 78. Okay, so so I have changed the figure of charity. It's 78,000 now. Out of that, gross chargeable estate after deducting that will be 922,000. From that, we will deduct these two items, and here the IHT rather than 40% will be 36%. So we'll write here 36%, and in formula we will correct it to 36% rather than 40. Now you tell me how much time did it saved, because I have just copied all of this data here. The formulas have copied as well. The same functionalities will work in your practice to pass platform. You can attempt this question there and try that you can write this data once, copy it along with formulas will copy automatically, and then paste it and just change the figures you want to. For example, I just wanted to change charity figure and just wanted to change this percentage from 40 to 36. The rest of the answer has been calculated automatically. Now if I want to calculate reduction, it is very easy. I will take this less this. It will tell me that if Kada would have made 78,000 charity, it would have saved 28,280 worth of tax for her. By just making 18,000 more charity, she would have saved this amount of tax. So reduction in IHT. There were many students yesterday asking me, sir, give us some tips. as to how to save the time in exam or the tips regarding the time management, it is one of the very good tips that try to work smart, copy the data where you just have to change few things. With the help of formulas, the answer will get automatic, will update automatically. Now, this is my working, so I will rate it as working number one, or whatever you can categorize that. So that was the solution of part B. Any issues, guys? Any questions regarding that? Yusuf, it's your choice. What you can do is, Yusuf has asked, sir, do we have to tell him that to achieve the reduction of 28 to 80, you have to further contribute the charity of 18,000. So the resultant saving will not be 28, because they further have to, provide 18,000 more, less 28 to 80. So the net effect will be 10 to 80. Yeah. So yes, Yusuf, it's your choice. You can tell your client that to achieve this, you have to make 18,000 of more charity, but it will save you the tax of 28,000. So net effect will be 10,000. Okay, guys, the value of Iman, sorry, I didn't understand your question. You have to post it again. The value of the estate has changed. The gross chargeable estate has decreased to 922 from 940. The estate above 1 million is before the charity, so it cannot be changed. The charity will be made out of that state 1 million. Now let's move on to the section C of the question. Explain the inheritance tax advantages which could be obtained by varying the terms of CARDA's will, and will set out the procedures required in order to achieve a tax effective variation. Now, guys, what happens in deed of variation? For that, we will go into our notes and revise this topic. What happens is that if somebody has died and they have gifted something to their descendants through will, and their descendants think that if the will would have been changed, or they would have the option to change the will, they could have saved much more tax. For example, just on the in part B, you have seen that if CARDA has made more charity, it would have saved 10,000 pounds of tax. So things like that comes into the mind of descendants who then had to pay the IHT. So HMRC has given them the option that even if they disagree with the will, they can change it, but there are certain conditions. And these are the conditions that if you would have remembered, you could have obtained very easy marks. The first condition is it must be written. It must be in written and written form and signed by all beneficiaries of previous and new will. For example, if somebody is getting out of the will and somebody is coming into the will as a beneficiary, both all of them should have signed and agreed. Then it should not be for any consideration or in return for change in will. For example, it shouldn't be that I am bribing or paying something to the other beneficiaries, or they are paying me anything. It cannot be that. Should be submitted within 2 years of death. It should be submitted in the written form to HMRC within 2 years of the death. So we will mention the death as well. In the exam, it has mentioned that the Kada has died on 20th November 2021. So they have the time till 20th November 2023 to submit this deed of variation. Okay, so this is very important that you should communicate the dates to your client as well. Then uh, one very important condition is that it should be for the change should be for tax efficiency. You have to prove HMRC that if we change the will in certain way, it will reduce our IHT. So HMRC is encouraging you that if you have a suggestion, normally what happens, when because I deal with UK clients as well, so let me tell you how this works in actual life. For example, a person has died and their descendants now has to pay IHT, and they don't have a clue as to what IHT is how it should be paid, what is the amount. So what they will do, they will go to an accountant or a tax consultant like us. They will then tell us all the information we require. For example, what was the bill, what are the market value of the assets and stuff like that. They will then ask us, sir, is there any possibility that you can help us to reduce our IHT? We will then tell them that if the will would have been in this way, the tax would have reduced. They will then ask, sir, is there any way to change the will? I will then tell them, yes, there's a deed of variation. And for that, these are the conditions. If you all of you agree and we prove these to HMRC, we can change the will and reduce the IHT resultantly. So that is how it works in real life. So now, what are the first of all, I will mention that this is the deed of variation and this is its what its conditions are, and then it has asked me that tell me the advantages as well, which will the Raymer and Yang will able to claim. So the first advantage is very easy that we have calculated in part A, that if they modify the will through deed of variation, they can make additional gift to charity and reduce their tax. The savings we have calculated in the part above. Then Raymer has identified in the question, we can see the question again, that he said that I do not intend to live in the house but give it to my son. So we will say here that if the Raymer does not want to does not intend to live in the house and does not want to keep it, by varying the will, they can transfer the house to Karda's grandchild and Raymer's son. Few of you might think, sir, then what about RNRB? RNRB will not be available. Then no, this is not the case. RNRB is available if the house has been left to children or grandchildren. So by still giving the house to grandchildren, the RNRB will be available. However, it will save the IHT of one generation. Now, so these are the two advantages. And another advantage is that if they do this way, it will not only save the one generation tax, but it will altogether exempt the asset from Raymer's IHT, because the Raymer has never got the house by changing the will. So you will not only mention these two advantages but also mention the procedures to score 6 marks. So guys, is there any question? Yusuf, the gift with reservation, the GWR, is a separate topic. It is that if a person transfers something to someone during their lifetime, but they attach a condition as well. For example, I transfer something to my son and a condition is attached that he cannot kick me out until I die. That is what we called gift with reservation. Here, no such thing is happening because the gift has been transferred on death, not in lifetime. Reservation normally means conditions. Gift with reservations mean gift with conditions. But here, the gift has not made during lifetime, so it cannot qualify as GWR, what we call gift with reservation as well. So guys, any question? Okay guys, a short 5 minutes break. In that break, you are allowed to post questions in the question section. And after the break, I'll quickly answer your question and then we'll move on to the next question. Okay, Tisham, you have asked a question. Can I explain about getting professional ethical marks? Uh, do listen to my yesterday's recording. At Tisham, I've explained about professional marks. For ethical marks, day 4, I have dedicated. I will be telling you as to how you can take ethical marks. It's very easy, and by listening to these two lectures, you'll be able to score those very essential 9 marks. 4 professional marks and 5 ethical marks that will get tested in section A. Sayed Raza, I do not share notes on daily basis. There are only one type of notes that will be uploaded daily for the students to download, and that are for the complete course. Aman Raval, you have asked me how to handle text planning question. All of the questions include text planning. For example, just now we were telling him as that how to do the gift deed of variation, but also what are the advantages he can obtain. And uh, if you are talking about complex type of planning question, I have selected those as well and will be solving those questions as well in the coming days. Okay, so guys, this question I have selected is from my question list is Demeter. It's of December 18 question. You can also find this in Kaplan examination practice kit, but you can also find that on practice to pass platform, ACCB practice platform, in the practice exam too. If you are unsure how to visit the practice platform, visit my yesterday's lecture. I have clearly taught you and walk you guys through the steps as to how you have to log in into the practice platform. Now, so this is the reason of the practice platform that ACCA created, that and I have chosen, that is that many of you might not have appeared for the CBE professional exams before, or at least for the professional exams, because the professional exam used to be, I mean, we used to have both options, the paper based and the computer based, but now the paper based is no longer available, so it is new to many of the students. So the practice to pass platform has the same outlay as your original exam, so you should familiarize yourself and you should solve the questions here, because it will help you not only to get familiar with that format, but also save your time. I have mentioned this yesterday. I will mention this again, that there were many students that failed the paper, and they told me that when they went into the exam, the outlook of the CBE exam was not that familiar to them, and uh, and the damage it caused was that they were unable to manage their time. Why? Because they have to figure out many things as to how to access spreadsheet, when to use word processor, and then typing speed, then use of formulas, because they haven't used it before. So I will strongly suggest to use the practice CB practice platform and get yourself familiarized with this outlay. Now, first of all, we will read the introduction of the question that will be on the main screen. Demeter has recently taken up new employment and is seeking advice on the tax treatment of certain components of his remuneration package and the relief available to reduce the chargeable gain on the sale of his house. Now, one of the student has just asked me, sir, how to deal tax planning question. Here you have to do the tax planning for him, that he is selling his house. How will you be able to reduce his CGT? Now, whenever someone is selling their house, if it is their main residence, two types of reliefs comes into my mind from CGT. One is PPR, principal private residence relief, and the second is letting relief. So depending upon the situation in the question, I will look into that what are the types of reliefs that are available. Now, the following exhibit available on the left hand side of the screen: scenario and requirements. Now let us read the requirements first. Explain the extent to which the receipt of 20,000 lump sum inducement payment and the relocation package in the relation to the Demeter's move to London will give rise to employment income for him. Whenever I see relocation, remember one thing, that HMRC has allowed that if your employer pays you because you are relocating your residence for your employment. For example, I used to live in Manchester, and now there is a company in London that has hired me. And because I have to move from Manchester to London, the company is helping me to cover up my costs. So they are paying me for the relocation. HMRC provides a limit up to where, if your employer helps you in relocating, it will not give rise to taxable benefit, but there is a limit to the exemption. Can anyone tell me in the question section that what is that limit? What is the limit on relocation expenses that will not give rise to taxable benefit? Thank you, Nabil. You are right. It is 8,000. Up to 8,000 if your employer, yes, guys, you're right. If up to 8,000, your employer provides you or helps you with the relocation, it is exempt. It does not give rise to taxable benefit. Now, guys, this is primarily the topic of F6 or the taxation exam. And in the advanced taxation exam, we usually ignore these small topics of exempt benefits or like this. But this question clearly tells you as to how important the taxation exam knowledge or the F6 knowledge is when it comes to passing the advanced taxation, and that what I also emphasized yesterday as well. So yes, you're right. So we will look into it as to how much Demeter's company has helped him in moving to London, but out of that 8,000 is exempt. But we have to make sure that he has spent more than 8,000 on qualifying expenditure. Qualifying expenditure means that was necessary to relocate. For example, if he has spent something from that money on some layer activity, that is not a qualifying expenditure. The expenditure needs to be absolutely necessary to move from one to another. Okay. Now, the second part says identify. And one more thing, guys, as far as the inducement payment is concerned, it is also called golden handshakes or hellos. Golden handshake or hellos means that sometimes a company wants to hire you, and they give, with the salary package, they give you an added benefit for attraction, and that is that we will provide you a lump sum amount if you join us. On top of that salary, we will provide you that lump sum amount. So all of these amounts that your employer provides you lump sum on leaving the organization or joining the organization. Joining the organization payments are called inducement payments or golden hellos. Leaving the organization payments are called golden handshakes. All of these payments are taxable, and they will be treated as part of your employment income. So this 20,000 is totally taxable. Now moving on to part B, identify and calculate with brief explanations. Here you can clearly see the frustration of the examiner. The students do not explain, they only do the calculations and unable to score a pass mark. So we do not have to identify and calculate, but also we have to explain briefly. The relief is available to Demeter to reduce the chargeable gain of 94,000 on the sale of his house in Manchester on 31st October 2021. If this is the house which Demeter is selling because he is now relocating to London, it would be his main residence, and I guess PPR will be available. But I have to read the question to confirm. Explain with supporting calculations the tax consequences of Demeter participating in Posden's or P Limited's approved occupational pension scheme. Number one, that is 5 marks. And the second is P Limited's non-tax advantage share option scheme in respect of the grant of the options on 1st December 2021 and exercise of the option and subsequent sale. Now, two topics here, pensions and share option schemes. And I guess that students do not find pensions or especially the share option schemes that easy. And it usually creates a lot of trouble for many students, especially the share option schemes. So we will revise the share option schemes, and I will share few tips and tricks with you as to how to deal the questions. But first we have to check that what are the tax implications of approved scheme and unapproved scheme, and what are the instances or terminologies which we normally see in this topic called grant date, exercise date, disposal date. What are these? We'll look into it shortly. So we are done with the requirements. So before I start reading the scenarios, if you have any question, please put it into the question section. Whenever I will visit the question section in between, I will try to answer your questions. Now, D is UK resident and domiciled, commenced employment with P Limited on 1st December 2021, will have no source of income other than from P Limited in all relevant future taxes. He's a higher rate taxpayer. So this is very important, because if I have to calculate anything regarding income tax, the rate will be 40%, and if for CGT, the rate will be 28% for residential properties and 20% for other assets. Now, has relocated to London from Manchester, a city more than 150 miles north of London, to take up his employment. Remuneration package from P Limited was that he will receive a salary of 220,000. Now, with that high salary, I assure you that you will not be able to have the personal allowance available, because once your income exceeds 125,000, you're not entitled to personal allowance. Uh, on 1st December 2021, P Limited made a one-off lump sum payment of 20,000 to Demeter as an inducement to take up the employment with the company. I've already told you that this 20,000 here is completely taxable. Now, P Limited paid Demeter 5,000 towards his cost of relocating to London. The company also paying him 1,500 each month for 4 months from 1st December towards renting accommodation in London until he purchases a new house on April. So these are 4 months: January, February, March, April. So, oh, sorry, December, January, February, March. These are the 4 months, and the company is paying him 1,500 each month. So 1,500 times 4 equals to 6,000, plus the company has paid 5,000 apart from the rent. So it's 11,000 in total. Out of that, what we have discussed already, 8,000 will be exempt, and on 3,000 it will be created as a taxable benefit in kind, and therefore it will be added into his employment income. Now, till now we know that 3,000 is taxable, but we have to read the question further just to check that is there anything else related to that part. Okay, on 1st December 2021, D was granted share options in P non-tax advantage, which means unapproved share option scheme as well. From 6 April 2022, D will participate in P Limited's occupational pension scheme. That's fine. Relocation to London, D incurred costs. Now, 11,000 has been paid by the company. Now, this part is telling you how much he has actually incurred. So the company has helped him by paying him 11,000. These are the actual expenses that he has actually incurred. If these expenses exceed 11,000 and they will be qualifying expenditure, we will give him the complete 8,000 exemption. So D has incurred cost in relation to relocation of 6,000. So he has incurred 6,000. This fee includes the estate agent fee, which he has to pay him to sell his house in Manchester. That's fine. It is a qualifying expenditure, because obviously without selling the house, he cannot, move to London. D signed a 4-month lease contract for a flat, and the company is paying him 1,500. The company is paying him 1,500 per month, helping him. However, the flat he has actually let out is for 1,700. So 1,700 times 4, that is 6,800. That is his one cost, plus he has incurred 6,000 apart from it. So he has spent 12,800, which means that he has spent more than 8,000 on qualifying expenditure, so we can give him complete 8,000 exemption. So our answer will remain same, that is the company has helped him win 11,000 and 8,000 out of that is exempt. The 12,800 does not has to do anything with the tax calculations. I have just calculated that figure just to make sure that did he actually spend that money, so that it's for that only. So what about the house for which we have to calculate capital gain and suggest that is there any relief available? So guys, how many of you agree that I believe that PPR is available for this house? Tell me in yes or no. For his house in Manchester, I believe the PPR is available. Thank you. Now, let's go to the notes and revise the PPR quickly. So then when we'll be performing the calculations, we don't have to come back. So in capital gains of my notes, you can find PPR. There you can find all of the reliefs, and that's PPR. So guys, how to calculate PPR relief? Whatever the gain is on the property multiplied by period of occupancy, actual plus deemed. Deemed means assumptionary, which means that you were not actually living in the house, but HMRC will assume that you were living. So we'll see what is the criteria of that. Divide by total period of ownership. In this way, you will get the PPR exemption. Then you have to deduct this exemption from the gain again, from this gain figure again. Then you'll be able to calculate the taxable gain. So what is deemed occupancy? 3 years for any reason. If you were away from your house, you were not living in your house, but you were away for 3 years, HMRC will assume that you were living in the house. 4 years for working within the UK, any period for working abroad, and last 9 months are unconditional. Last 9 months are unconditional. So guys, last 9 months is the change from this for this finance sector. It used to be last 18 months. HMRC has half the period to 9 months now. So do remember, this is the change. You might have studied 18 months in taxation exam, but it has now been changed and reduced to 9 months. So let's get back to the question and let's see that did he lived in his house completely or was he away? So guys, before I move on, if you guys can quickly raise your hand and let me know that you can clearly see this question, I do have to zoom in further. Quickly raise your hands, please, if you can see the screen clearly. Okay, so I guess most of you wants me to zoom the screen, so I will zoom it a bit further. Okay, guys, now Demeter has purchased the house on February 2009. It is very important because we needs to be on top of the dates if we have to calculate the gain for the PPR. So we need to be on the top of the dates. Now, from 1st February 2009, he started to live in the residence. Demeter let the top floor of the house, comprising 30% of the total house, to tenants from 1st February 2011 to 31st October 2021, which means that before 1st February 2011, the tenants were not living in the house, only Demeter was living, and then he let out only the top floor, the remaining 70% house was in his possession. Now, I believe that if you let out your house, any part of your house, the PPR gets restricted. Answer me in yes or no if you agree with me. Does it gets restricted or not? Yes, Ravi, you're absolutely right. It gets restricted. However, on that period, you can get letting relief. So the letting relief is only available if you are not using your main residence and rather you have let it out specific period. For that, PPR is not available. However, another relief is available that is called letting relief. So you guys are absolutely right. But do remember, from February 2009 till February 2011, these are 2 years. and 24 months to be precise, because we have to do the calculation in months for PPR. For 24 months, he actually occupied the house as a resident, but for the remaining years from February 2011 to 31st October 2021, the house was partially occupied by Demeter. So let me quickly calculate how many years it becomes. In January exactly, it will become in January 2021, it will become 10 years. And then I can count month from that onwards: February, March, April, May, June, July, August, September, October. I guess 10 years and 9 months. How many months, guys? Do your calculation and let me know in the answer. Okay. Do remember, when you will attempt this question from the Kaplan's kit, the dates are a little bit changed. However, the figures are the same, but the dates are little bit changed. Okay, so yes, it's 129 months, Rajiv, if we talk about months in total, because 12 times 10 years equals to 120 months for 10 years. Then we'll add 9 months separately, it will be 120 months. When the entire house was sold, which means that his total occupancy of the house is 129 plus the 24 months in which he was living alone in the house. 153 is the total occupancy for him for the house. Correct, guys? 24 months he lived in the house separately, and then 129 months along with that he occupied the house partially. Now, the sale will give rise the sale will give rise to a gain before any reliefs of 94,000. Demeter did not own any other house throughout the period from 1st February 2009 to 31st October. So guys, if you have to do the calculations, I'll open the spreadsheet here and we'll make a column here. Here this column I will dedicate to the descriptions, for example, the dates, and here we will write the months. There we will write exempt months, and this column I can dedicate to chargeable months. Now, the dates is from 1st Feb 2008, if I remember correctly. Yes. So from 1st February 2009 till February 11. So let us open the spreadsheet. February 9 till Jan 11. These are the exempt months because actual occupation. You can also make another column called reason, just to tell that why are you giving it an exemption and why aren't you charging it. The reason is actual occupation of the house. Now the months are 24 from 2009 till 2011. Then from 1st February 11 to till 31st October. But the problem is the last 9 months are unconditional. The last 9 months are unconditional, and they can qualify for the exemption anyways. So I will remove the last 9 months that uh, he spent in his house he as a shared occupation. I will only take till Jan 21, partial occupation. So guys, it's 120 months in total, but as he has occupied the house 70%, I will have to multiply it by 70% to check how many days will it become for the PPR. It's 84 days for PPR, and 120 times 30% will be chargeable months. They will not qualify for PPR. And then from 1st Feb 21 till October 21, last 9 months will be exempt anyways. So then we can apply a sum formula which will add all of these months. It's 117, and we can copy the same formula here. So the total months are equals to this plus this. 153 months in total, out of which 117 are exempt and 36 are chargeable. Guys, before I move on to any further calculations, I want to raise your hands if you have understood the calculations till here. Ravi have asked me why I have taken 70% of the 129. Reason because he has only occupied the house for 70% and 30% was let out, so that will qualify for letting exemption later on. Quickly raise your hands, guys. Your participation is appreciated. Thank you for all of those who have raised their hands. Okay. Why the 36 days are chargeable? You have asked. Because he has not occupied 30% of the house in those days. That was let out. So they cannot qualify for PPR. That is why they are chargeable. Now let us calculate PPR exemption. Its gain. Its formula is gain times actual plus deemed period divided by total period. That is what the formula is. And if we do the same, the gain here is, in the question, it was 94,000. We multiply it by 117, divided it by 153. Why 117? Because 117 is the sum of actual plus deemed occupation, and 153 are the total months. So to round it off, we'll select this format. It's 71882 is the PPR exemption, guys. And to calculate the taxable gain, it will be gain less PPR exemption less letting relief. But we haven't calculated the letting relief, but we can apply the formulas here, and whenever we will calculate, we can put the figures here. So let's leave some space for letting relief first. Let's calculate letting relief. Before letting relief, I'll take you to my notes. How to calculate letting relief? It is available on the period in which the house has been let out and not been occupied, and letting relief will be lower of either 40,000, that's a fixed amount given by HMRC, or the PPR exemption. We have these two amounts available. And the third is gain on letting period. How to calculate gain on letting period? All you have to take is take the total gain that is given into the question, or you have calculated yourself if you have, then divided it by total number of months. So the total gain that is given into the question is 94,000. If I divided it by 153, that are the total months, I'll get the gain per month. Then I have to multiply it by the number of months in which the house has been let out to calculate the gain on letting period. So gain on letting period will be lower of, one is 40,000, second PPR exemption, that is this, and third is gain on letting period. Let's calculate gain on letting period. It's 94,000 divided it by 153 times it by 36, and let me increase the size of the screen so you guys can clearly see my complete workings. All I have to do is put the format here. So guys, you tell me which one is the lower, one, two, or third? Nabil, you have asked me to repeat the formula. The formula is pretty easy. You have to calculate gain on letting period. For that, take the total gain. So the total gain was given into the question, it's 94,000. Divided it by total number of months he has occupied the property, it's 153. Then multiply it by only the number of months the property was let out. Okay, so I have taken 94,000, divided it by 153, and then multiplied by 36. Yes, guys, third is the lowest, so that will be the PPR exemption. Now we will calculate the taxable gain. It's 94,000 less PPR exemption. So this is the PPR exemption less letting relief, and this is the letting relief. Okay, guys, so my gain is this minus this minus this. So there will be no taxable gain. Why is that? Because the PPR exemptions and the letting relief has covered all of my gain. So I do not have to pay anything. Any issue, guys? Any questions? Okay. Now let's assume that there would have been some period which would have been chargeable as well. Then what do you have to do? That period would have would have taxed at 28%. Why? Because these are the resident properties. But here, all of his gain has been exempted due to the availability of number one, the PPR, and number two, the letting relief. So he will not have to pay any reliefs. Now, guys, you have clearly seen that in the question. I will take you again to the question, especially to the requirements, that we have to explain with brief calculations. So you'll explain it that the relief that will be available will be PPR, and it will be available for the period in which he has actually occupied the house, or the deemed occupation, which will be last 9 months that are allowed by HMRC. Then you will perform this calculation. Then you will write the period for which the house was let out will get the letting relief, and that's how the letting relief is calculated. Therefore, the remaining gain will be attributable to the letting relief. And that is how you not only explain, perform the calculations, and this is how you provide the answer to the parts that not only include the calculations but also the explanations. Then let's move on to the tricky topics, that is the pension and the schemes. So his salary is 220,000. Do you remember that? It was mentioned in the question. I'll take you to my notes where we have the topic of pension in the income tax. There are two types of pensions, occupational pension and personal pension. Personal pension contributions are which you make with the private pension providers. Occupational pension contributions are the one which you make into your company's pension fund. So only employees who are working somewhere with some company can make the occupational pension contribution. Obviously, if a person is self-employed, he will not have any boss or any company which have a fund in which he can contribute. So for self-employed people, only option is personal pension contribution. For employed people, they can make occupational pension contributions as well into their company's occupational pension scheme, and they can make personal pensions contribution with a private pension provider outside the company. So they have both options available. Both have different type of reliefs available. For personal pension contribution, if you contribute, you have to contribute 80%. 20% will be contributed by government on your behalf. Your bands will be extended by the gross amount, and your adjusted net income will reduce. Adjusted net income is the benchmark on which the HMRC decides whether you are eligible for the personal allowance and the child benefit or not. So these are the two benefits for the personal pension. For occupational pension, it is an allowable deduction, which means whatever the amount you will make into the occupational pension contribution, it will be deducted from your employment income, thus will reduce your salary and your tax on the salary. That is the only benefit on occupational pension contribution. Now, is there any limit on one to make the contributions? Yes, there is. HMRC has announced a limit, that what we called annual allowance. So, and in annual allowance, if you contribute up till 40,000 every year, you will not get charged any tax, and you will avail all the benefits that are available on making pension contributions. If you do not use your annual allowance every year, you are allowed to carry forward the unused annual allowance for 3 years. So at any point of time, you can carry forward your last 3 years unused annual allowance. If you contribute above 40,000, if you contribute above 40,000, you will be charged tax on the amount of contribution that is above 40,000. What is the amount of tax? Whatever the band that is applicable on you. If you're a high rate band payer, then 40%. If basic, then 20. If additional, then 45. So now we have the idea what the pension per occupational pension contribution is, what is the limit. So now we can move back to the question and see what is happening there. So I will close this spreadsheet for the moment and we'll get back onto it when we have to perform any calculations. Demeter has made tax allowable contributions of 40,000 to a personal pension for the last 5 years, which means he is using his complete annual allowance for the last 5 years and will continue to do so, which means that the annual allowance is not available from the past years and it will not be available in the future as well. But from tax year 22-23, P Limited will contribute an amount equal to 10% of Demeter's salary into its approved occupational pension scheme. Now guys, in occupational pension scheme, you have the both options available. You can contribute out of your pocket into the pension scheme, and your employer can contribute directly into your pension scheme from his pocket. Your employer is contributing into the pension scheme from his own pocket, it will not be a taxable benefit, rather it will be an exempt benefit for you. So you are getting the money into your pension pot, but it will not be constituted as a exempt benefit. But there is a disadvantage of that as well. that employer's contributions are also considered to be part of your annual allowance, which means 40,000 is limit for all of the contributions, either made by yourself or by your employer. So if P Limited will make a contribution on D's behalf, they will exceed his annual allowance, which means it will attract a tax charge. So guys, let's quickly look that what is the available limit of what is the available annual allowance that is available for D. So his income is 220,000. Out of that, I have to deduct 40,000 because that he is making in the uh, contributions. So 180 is the amount. Let me take you to another topic with this, that is tapered annual allowance. 40,000 complete annual allowance is for the people who are normal income individual and not the high income individual. Now, what do I mean by that? If you are earning more than 150,000, your annual allowance will get taper as well. You will not gonna get the complete annual allowance like other people. And what is the limit? More than 150. If your income exceeds 150, for exceeding every £2, £1 of annual allowance will get reduced. Or you can say, let's say if I'm earning 160,000, if I'm earning 160,000, my income is 10,000 above the threshold. Take 50% of that, that is 5,000. 5,000 of annual allowance will not be available. Rather, 35,000 of annual allowance will be available. So D's income is very high. It's 220. However, to calculate the threshold, you have to deduct if one has made any pension contributions, and D has made pension contributions of 40,000. So his income will be considered as 180, but it's still above the threshold. If I deduct 150 out of that to check how much it is above the threshold, it is 30,000 above the threshold. If I take 50% of that, it's 15,000. 15,000 worth of annual allowance will not be available. So how much annual allowance will then be available out of total 40? 25,000 of annual allowance is available to D. Why? Because income is so high. Now how much he is utilizing? 40,000 pension contributions by himself, 10% of his salary by his employer. So his salary is 220,000 times 10%, 22,000. Let me confirm his salary again from the question. Yes, 220,000 it is. So 22,000 and 40,000, 62,000 of contributions. 40,000 by himself, 22,000 by his company, and the only personal allowance available for him is 37,000 or 25,000. So he's contributing 37,000 above his annual allowance. Let me go through the workings again with you. His salary is 220,000 minus the contributions he has already made, that is 40,000. To check how much it is above, 30,000 it is above the threshold. 50% of that is 15,000. So 15,000 annual allowance will not be available. So 40,000 minus 15,000, 25,000 annual allowance is then available for D. But he is contributing 62,000. So he is contributing 37,000 above the threshold, above his annual allowance. So it will attract tax charge, and obviously with such high salary, he will be higher rate taxpayer, and it is clearly mentioned in the question. So 40% tax on that. 14,800 will be the additional tax that D will have to pay because of crossing the pension contributions of annual allowance limit. Now guys, I know it was a bit tricky. If you have understood it clearly, please raise your hands. If not, then post your questions in the in the question section. Sati, no, it's 150,000. I haven't got 65,000, Ravi. It's 62,000. That is 40,000 of the contribution himself and 22,000, that is 10% of his salary by his employer. So there is no such figure like 65,000. No, Nabil, obviously there is no allowance left for carry forward because his allowance is already reduced and he is using it completely. The only allowance that you can carry forward is the unused annual allowance. For example, if your annual allowance is 40,000 and you have just used 10,000, you can then carry forward the remaining 30,000. It is mentioned in the question, Nabil, that he is using complete 40,000 since quite many years. So that is the case. Guys, I hope that I have answered your questions. Any further questions? Okay, guys. Now let's move on to the next part. That was regarding the share options. P Limited share option scheme. On 1st December, P Limited granted D options over 3,000 shares in its unapproved share option scheme at 5% discount on the market value of the shares. The market value of the shares were 420. So let's see that what will be the 5% discount. So 4.20 times 5%. So the discount was 21 pence minus 4.20. So 3.99 almost was the price on which P was granted the options. D will exercise the options on this date and will immediately sell the shares. P Limited believe that on that date, that is 6 April 2027, the shares will be 6 per share. Now, guys, we have to move on to the notes to see that what are the tax consequences of the approved and unapproved share option schemes. In my notes, where the topic starts called share options, you will first find a table which will tell you the difference of the tax implications between HMRC's approved scheme and unapproved scheme. And there are three instances in all of the schemes: grant date, exercise date, disposal date. Let me kick out the easiest one first. That is the disposal date. Disposal date means when you sell the shares. That is the easiest instance. Grant date is date on which I, being a company, promises with you that I will give you a shares in on a specified price on a specified date. So A Limited will promise that I will give you this amount of shares on that date. So the promise date is called grant date, on which no such shares have been given actually, only the promise has been made. The exercise date is normally the date on which the promise will be fulfilled, on which the company will actually give the person shares on that promised date and price. So that is the exercise date. Now, now you have the idea what is grant date. It is the date on which the promise is being made. Exercise date is the date on which the promise is being fulfilled. And disposal date is the date on which, after getting the shares, you're actually being disposing it. Now, guys, in our question D, he's getting the shares, he's getting the promise on 1st December 2021. So that will be the grant date. He will be exercising the shares on 6 April 2027. That will be the exercising date on which the promise will be fulfilled. And it will he will dispose of the shares on the same day, so the disposal date and the exercise dates are same in our question. So what are the tax implications? Either your scheme is approved or unapproved. On grant date, there are no tax implications. On exercise date, if your scheme is approved, still there will be no tax implications. But if your scheme is unapproved, there will be some tax implications on exercise date. What are the tax implications? You have to pay income tax and national insurance contributions on the difference between market value at the exercise date. Exercise date is again the date on which the promise is being fulfilled, less exercise price. Exercise price is the price on which you are promised to get the shares. Okay, less cost of option. If you have paid anything extra, you will deduct it as cost of option. Whatever is left is a taxable benefit in kind per share. Then you have to multiply it by total number of shares. So let's get back to the question. I was promised that I will get the share option scheme at 5% discount on the market value of the shares on that date. So I have been promised on 1st December 2021. On that date, the price was 4.20, and after taking 5% discount, we have already calculated that the price is 3.99, right? Now, Demeter will exercise the options on 6 April, on which the price will be £6 per share. So let us take the difference. 6 minus 3.99 will be the NIC contributions, or we have to include the NIC contributions into our answer. So it clearly states ignore the NIC in part 1 and 2. So I will not be taking NIC. Otherwise, it would have been 42% tax on this amount, 40% tax and 2% NIC. But because I have to ignore the NIC contributions, and it is clearly mentioned that D is the higher rate band taxpayer. So on this figure, there will be a 40% tax. That is 2412. That is the amount of tax that will be on the share options that have been granted to him. So guys, any question if you haven't understood this, I have tried to explain in an easy way as I can, but if you have anything that you can't hear, please let me know. Any issue guys? Any questions? Few I might have lost audio in between. If you guys want to want me to repeat a specific point, please highlight and I will repeat it. Okay, I might have lost the audio, so let me quickly repeat. In the share option, there are three instances: grant date, exercise date, and disposal date. Grant date is the date on which the company only promises. Exercise date is the date on which the promise actually gets fulfilled and you actually get the shares. And disposal date is the date on which you actually sell the shares. If your scheme is unapproved, you're going to have the tax implications on exercise date. What are these implications? You have to take the difference between market value at the exercise date less the price on which you were promised. So in my question, the price on which I was promised was 3.99, that is 5% discount on 4.20. And on the date on which the promise actually got fulfilled, the value of each share was 6. So 6 minus 3.99 2.01 was the gain on per share, which was subject to income tax and NIC. Multiply it by 3000, it's 6030. That is the total gain. It will subject to 40% tax and 2% NIC, but as we have to ignore the NIC, I will only take 40%. 2412 is the total amount of tax that D needs to pay. Guys, is it clear? I have repeated for your convenience. Also, please raise your hands if all of you have understood till here. Your participation is highly required. Please raise your hands for me. Come on, students, I need more hands to be raised. Thank you. If there is any such question, guys, you can put into the question section. We have now completed this question and we'll be moving on to a 5 minutes break. In the break, you are more than welcome to put your questions in the question box, and after the break, I will try to answer. I have selected this question because of two topics that students usually have difficulties in understanding. One is the share option schemes and one is the pension. See you after the break, guys. Okay, guys. So one of the student has asked that uh, is there a link to rewatch the webinar? Yes. ACCA uploads the recording of the webinar daily on their Vimeo channel. The link will be shared with you shortly, so you can rewatch it anytime you can. Any other question from any other student, or shall we move on to the next question? Okay, guys. So let's move on to the new question. The new question is in it, and I have selected this question from September 18 attempt. It is also available on Practice to Pass platform. It is available on Practice Exam 1. So without further delaying, let's move on to the requirements. If you guys have any questions, you can put it into the question section and I will try to answer in between. Okay. Explain how Innate can obtain relief for the trading losses of 51,000 brought forward in her unincorporated business at 6th April 2021. So I remember that there was a student asked me about, sir, what about losses? They gets usually tested. So there's a question on the loss. Then, explain why the transfer of E's business to N Limited qualifies for the incorporation relief and on the assumption that E does not elect to disapply the relief. Calculate the balance on her loan account with N Limited after deducting the cash to be withdrawn to pay any capital gains tax due. So what we're gonna do is we'll calculate that what is the CGT needs to be paid, and then whatever it is, we will deduct it from the loan account of E. And as far as I remember, incorporation relief is normally available if you are, performing a business as a sole trader and then you decide to incorporate your business into a company. So on that, incorporation relief is available. Now, moving on, Part C, advise E of the impact on the total amount of tax payable by both herself and Unlimited if instead of a dividend of 15,000 she receives additional salary of 15,000 or alternatively withdraws 15,000 from her loan account in the tax year 2022-23. Now, this is a very popular type of requirement in which you have to make the comparison between the two options. You then have to compare the tax implications of the both options and suggest the client in which option will the tax be the minimum. There was a student who asked, sir, what about the tax planning questions? Here you are with a tax planning question as well. Then D. Advise E of her administrative obligations under the VAT legislation arising from the transfer of her business to Unlimited and whether or not she is able to transfer the VAT registration from an unincorporated business to Unlimited. Guys, do remember that the option to transfer the business from unincorporated to incorporated of VAT registration is available. However, one has to remember that if I will transfer my VAT registration to my own company, the company has to take all the VAT liabilities along with the registration as well, which haven't paid or settled by myself. So if I have the VAT is currently on my personal name and I have now incorporated a company and I want to transfer the VAT registration, all of my liabilities will also be transferred with the registration. So the option is still available there. So for 3 marks, I will be telling that yes, the option is available. And the first part of the requirement relates to advise my administrative obligations. My administrative obligation is being a sole proprietor, that as I have now stopped working as a sole proprietor or sole trader, I should cancel my registration and inform HMRC. And my company should apply for the new registration. If not, and I want to choose that I want to transfer my registration, that option is also available. provided that the company is ready to take all the liabilities as well. So that is the answer to the last part. Okay, so now we are left with the first three parts. So let's read the question and then we will figure out as to what to suggest for the parts above. Guys, before I move on, quickly please raise your hand so I can identify that there is no audio issues now. Okay, thank you. Now, moving on to the scenario, let's close the requirement. Okay, I hope that now it's clear. E has been in a business as an unincorporated sole trader for many years, receives dividends from a portfolio of investments of 1000 each year. Guys, this line is very important. Why? Because I should be careful that 1000 of nil rate band of dividend has a nil rate band of 2000, that if you receive every year dividends of 2000 there will be no income tax. Here he has already utilized 1000, so only 1000 will be available if there will be any discussion related to dividend in the later part of the question. I should remember that. He has no other sources of income, is a high rate taxpayer for all relevant tax years, that is fine. Will transfer all these assets and liabilities to her business unlimited on 1st October 2021. So that is very important date. Okay. Will make no other disposals for CGT purposes, which means our complete annual exemption is available. Whenever examiner writes this line, he's providing you a hint that please do use annual exemption. Complete of the annual exemption is available. Now, will be the only director and shareholder of Unlimited, which means it will be a closed company. Now, E is incorporated business. On 1st October, E has trading losses brought forward of 51,000. That's fine. In the year ending 31st October 2021, E business will have a taxable trading profit of 42,000 prior to the transfer of Unlimited. So the examiner is talking about 2 years before the transfer of business to company. In year 2020, he had losses, but just before transferring the business to company in year 2021, he had profits of 42,000. So I guess one relief that will automatically be applicable on his losses will be carry forward losses. Carry forward against the same trade is automatically applicable, that if you have received a losses and later on you make profits on the same trade, these losses will get set off against those profits. So out of the 51,000 losses, 42 will set off against the year 2021 and he will only be left with 9,000. So we'll see that what is the relief that is available for the 9,000 losses. If he has any incomes before that period, he can carry back. If he has any incomes coming in future, he can carry forward that losses to that. For example, if he is going to earn anything from company like a salary or a dividend, he can carry forward that loss against that income. If not, then he cannot, and he has to wait till he earns some income from either his own company or somewhere else to settle these losses. So I guess as far as the first part is concerned, that how the losses can be relieved, we can say that out of that, the 42,000 losses will be offset against the first available profits from the same trade, and the remaining 9,000 losses will be relieved against any incomes he will receive in the future, either from his own company or from somewhere else. Now, let's refer to other parts. The assets and liabilities to be transferred to Unlimited. So it has a goodwill, obviously, because he has started the business from scratch. So there will be no cost of the goodwill, only the proceeds. Then we have the workshop whose value is 122,000 less 55,000 of the cost. Inventory is a current asset, and current assets are exempt from capital gains. So we will not take inventory in the calculation of CGT. Liabilities are 10,000. Obviously, liabilities are also not part of the capital gains tax. So we will leave the capital gains tax. Guys, do remember this question is also available in the Kaplan's Gate. However, there the figure of the goodwill is changed. It's 83,000. So don't get confused while checking the answers from there. However, you can find the answer to this question from the practice platform as well that I have explained in yesterday's lecture. Please refer to my yesterday's video for that. Now, if I have to calculate the gain, I will open the spreadsheet here. So the assets that he has transferred to the company, it was goodwill, and for goodwill, the proceeds were 100,000. However, there was no cost, so the total gain is 100,000. Then we have the second asset, that is workshop. 122,000 is the proceeds and 55,000 is the cost. So, sorry, 122 less 55. 122,000 less 55,000, and here we'll apply the formula 122,000 minus 55,000. It's 67,000. We will exempt the inventory and we will tell the examiner that we know that the inventory is exempt. We have not skipped or forget. So do remember, if you will not write this exempt, you will not get a score any mark. So 0 for that. So the total gains are, we'll apply the sum formula. 167 is the total gain. Now let's move back. Consideration, how the company is going to pay E, because company is a separate legal entity. Company is buying all of these assets from E. So how the company is going to pay in return? So the company is paying 85% of the total value of the consideration of the business, and the total value is add all the assets less all the liabilities. So let's quickly calculate the total value of the business. It's 100,000 plus 122,000 plus 8,000 minus 10,000. All I have done is added all these figures less the liabilities just to see what is the actual value of the business. So the value of the business is 220,000. So the company is paying 85% of that as a value of shares to E. So the value of 1,000 shares of E will equivalent to 187,000. So the company has not paid the remaining amount to E. The remainder of the consideration will left on the loan amount payable by N Limited to E. So let's check what is the amount of loan. Out of 220,000, they have paid 187,000. 33,000 is the loan at the company's end. Do remember that. Company still needs to pay 33,000 back to E. E will withdraw cash from the loan account to pay any CGT liability arising on the transfer of the business. Because E will be considered, because the company will be considered as a separate legal entity, HMRC will assume that all of these assets was previously owned by E, and he is now selling all of these assets to the company. So HMRC will compute the capital gains tax on that, and the capital gains tax will needs to be paid by E. So when E has to pay the capital gains tax, what he will gonna do? He will ask the company to pay back his money that they still haven't paid. So that out of that he can settle the CGT liabilities. So we know the amount of loan, it is 33,000 that the company needs to pay to E, but we don't know what is the amount of CGT that E needs to pay. So let's go into the spreadsheet and calculate his capital gains tax. We have the capital gains tax, we will deduct annual exemption amount from that. That is 12,300. So the taxable gain is 154,700. Now guys, I will stop here and I will ask you, is there any relief available on this gain that has been made by E? Is there any relief from CGT available? Sorry guys, BPR is available in inheritance tax. It is not a CGT topic. What relief is available, guys? Quickly, I need more answers. Both of their answers are right. Few people have said BADR, few people have said incorporation relief. Yes, incorporation relief will also be available. So will be the business asset disposal relief. But for that, the incorporation relief needs to be applied before the annual exemption. So what we will do, we will keep our amounts separate, and out of this total gain, first we will less incorporation relief. Incorporation relief. Now guys, what is the formula of incorporation relief? Let me take you to my notes, and from there we will check what is the formula of incorporation relief. We have to find that topic in capital gains tax. There it is. And the formula is gain multiplied by proceeds that are in the form of shares divided by total proceeds. So the proceeds in the form of shares were 85%. So 85 divided by 100 means 85% times the gain, whatever the gain is. So we will perform the calculations onto the spreadsheet directly, and we will write here that the gain is 167,000. We will multiply it by 85, divided it by 100, because 85% of the gain qualifies for incorporation relief. What we can do is simply take 85% of that is the incorporation relief. So now gain will be this figure less this figure. So this will be our gain before applying the tax liability. Now what I can do is I can take these figures above, and here I have to update the formula. Rather than take this figure, take this figure for the gain and deduct the annual exemption out of that. So this will be my taxable gain, and on this gain BADR will be available. But the problem is, guys, BADR is available when you cease your business or sell your business on a going concern basis. So here E has sell the business to a company on a going concern basis, so BADR is available, but the BADR is not available on goodwill. So we have to separate the gain that relates to goodwill. Now, considering that this 167 includes 100,000 of goodwill and 67,000 of workshop, I will assume that out of this gain, obviously 85,000 would have related to the value that qualifies for incorporation relief and 15% does not relates to. So what we can see here is we can take that what is the percentage of out of this total gain that relates to goodwill. So this is the amount of goodwill divided it by this value and expressed in the form of percentage. So guys, 59.88% out of the total gain was related to goodwill. Obviously, the same percentage can be applied here as well, that out of this total gain, 59.88% would have qualified or would have been attributable to goodwill. So we will take this gain, multiply it by this percentage. So 7635 is the gain that relates to goodwill. So it cannot qualify for BADR, Business Asset Disposal Relief. So the remaining gain can qualify. So we have to make two columns, gains for BADR, other gains. And do remember, I will not deduct annual exemption from here. Why? Because it is always beneficial to deduct the annual exemption amount from non-BADR gains. So rather than this figure, I will take this figure. Oh, sorry, 15,000. So my gain that do qualify for BDR is this gain less this gain, because this gain does not qualify for BADR, and non-BADR gain is obviously 15,000. Now guys, we have to deduct the annual exemption amount. Now guys, you tell me what should be my preference to deduct the annual exemption amount, gains for BADR or the other gains? Yes, other gains first and then BADR. So out of my other gains, I will deduct the annual exemption amount, that is 12,300, and apply the sum formula. So it's 27 here. I'll copy this formula here. So the non-BADR gains will be taxed at 20%. So 10050 is a non-BADR gain. It will be taxed at 20%, considering him a high rate band taxpayer, and BADR gain will be taxed at 10%. So simply we'll do this times 20% and this times 10%. So our CGT liability in total is this adds this. This is the total CGT liability. But what we have to tell is that what is the amount that is left from the loan account after he deducts this amount. So guys, you remember that his total loan that has been left was the 15,000 of all the amounts. I guess it was 33,000. Let me check the history of my calculator. Yes, it was 33,000. 33,000 was the amount of loan. So after tax loan will be, we will write here, after tax loan amount. It will be 33,000 minus this amount. So guys, this is the after tax loan amount that N Limited needs to pay to E after settling his tax liabilities. I hope I have explained this. Let me quickly go through the requirements. So we have done with requirement A, we are done with requirement B, we are only left with requirement C. Before I move on to the requirement C, if anybody has any question, they can put in the question section. Okay, let me quickly check my calculations. Spreadsheet. Yes, sorry. So I've done the calculations wrongly. Rather than this should have been taxed at 10%, but I can easily correct it using the formula. Here I will write 10. Here I will write 20. And simply by updating percentages here, my answer will automatically get updated. So 10 here and 20 here. Now, this figures get updated as well, and this figure gets updated as well. So thank you everybody for correcting me. Yes, Yusuf, you're absolutely right. Yusuf said, sir, BADR also consumes your basic rate band if left any. Yes, Yusuf, you're right. Everybody that has identified the mistake, thank you very much. That does tell that you are attentively attending the webinar. Thank you so much for highlighting the issue. Any other questions, guys, before I move on to the next requirement? Okay, so let's move on to the next requirement, in which we have to state that what is better. Will Unlimited will pay E a salary of 75,000 per year and a dividends of 15,000 on 31st March each year. It will not regard it as a personal service company under IR 35 regulations. That's fine. Let's read the requirement. What do we have to suggest? We have to tell between two different options. One, what if she receives additional salary of 15,000? Number one. Number two, what if she withdraws 15,000 from her loan account? Guys, I will talk about the second option first. If she takes out 15,000 from her loan account. If she takes out 15,000 from her loan account, it will not give rise to any tax liability. Why? Because it is his money which the company was supposed to give him. So obviously, if you have lent something to someone and he's repaying you, it is not your income. Rather, you are getting back your money. So if he will be, getting the money back from his loan account, there will be no tax implications, both for the E and for the Unlimited, because there will be reduction in Unlimited's liabilities, which will not have any impact on the corporation tax, and for E, it will not give rise to the taxable benefit. So I have ruled out the second option first, and in first option, it has asked me what if it will get a 15,000 of salary. Obviously, if it will get a salary, there are certain implications from E's point of view and Unlimited's point of view. I will discuss the E's point of view first, and for that, let's open the spreadsheet as well. So, guys, obviously, if E will take salary, so let's write E's point of view. The 15,000 on 15,000 salary, he has to pay 40,000 on 15,000 of salary. He has to pay 40% of tax and 2% of NI, class 2 employees NI. Okay, so it will be 42% tax on that. 42% is inclusive of NI. So it will be 15,000 times 42%. It will be 6,300 in total. That is E's point of view. In this way, he has to pay this much tax. Let's talk about N limited. What about that? For N limited, obviously N will be earning tax savings on the 15,000 that they will be paying to E. So they will be making tax savings on that salary, and they will be making tax savings, corporation tax savings on class 1 employers NIC that they will be paying on E's behalf. So we first have to calculate what is the class 1 employers NIC. The rate of employers and one NIC is 13.8%. So obviously employer NI will be 15,000 times 13.8%. So that is 2070, right? Now, what will be the tax savings? Tax savings will be 15,000 salary will be treated as an expense and thus will reduce the corporation tax profits and the tax as well, plus 2070 will also be treated as an expense times 19%. So this will be the tax savings. So 15,000 plus 2070. Let's put brackets so the software knows that it has to add first and then multiply it by 19%. 3243 are the tax savings, and if I add minus at the very start of the equals to, it will convert the complete figure into negative. So this is the cost that Unlimited will bear, but this is the tax saving that Unlimited will achieve. So Unlimited will be better off by 1173. So for Init, there'll be tax expense. However, for E, there'll be tax savings. So what will be the net effect? It will be this minus this. This is the amount of tax that will be payable if she will withdraw 15,000 more salary. Now I have to compare it with 15,000 dividends which he was previously taking as per the question. That is what the requirement said. The requirement said that instead of 15,000 dividend, what will be the tax implications if he receives 15,000 of salary or she receives 15,000 from her loan account. I already told you that there will be no tax implications by receiving the money from loan account. However, if she takes salaries of 15,000, there will be tax and NI payable by her, and then the company will make savings. However, the net saving is, or the net tax payable is 5127. Let's compare it with dividend so that we can tell in which position she will be better off. So in dividend, she'll be taking 15,000 dividend. Out of that, 1,000 is available from the nil rate band because she's already receiving 1,000 dividend every year that is mentioned in the start of the question. And remaining, considering her a high rate band, will be payable at 32.5%. So I can directly take 14,000 into 4,550 is the tax. So guys, you tell me in which option is she better off? Shall she take the dividend or shall she go for the salary, 15,000 salary? Which option is better? Or In loan account, the tax is zero. So you tell me, out of these three options, which one is the best? For those who said dividend, wrong answer. Loan account is the correct because in loan account there is no tax. So by mentioning all these tax implications, you're already telling examiner that you know what is the impact of these options. But as far as the suggestion is concerned, we will be suggesting loan account because there is no tax applicable on taking your money back as a loan from the company. Obviously, this option can only work till the company has paid the loan off. After that, she has to choose from either the dividend or the salary, and then the dividend option will be better. But right now, the dividend, oh sorry, the loan option is better. Nabil wants me to quickly repeat the salary calculation. Nabil, it's pretty straightforward. Rather than taking the additional 15,000 dividend, if she take it as a salary, she has to pay 40% tax on that, income tax being a high rate band payer, and 2% NI, which is 6,300. That's it. I hope I have now cleared. And with that, I have also finished the question. Any questions related to that? Okay, guys. With that, let's take a quick 5 minute break as we are done with all the requirements. And then we'll do our last question after the break. Meanwhile, you can post whatever questions you have in mind in the question section. I will answer it after the break. Okay, guys. So Ravi has asked, did the dividend have any impact on Unlimited from the last question? Ravi, do remember that whenever the company pays dividend, the dividend are deducted from profit after tax. So the dividend will not provide any tax savings to companies. So because the dividends are always deducted from profit after tax. Okay, guys. So let's move on to the next question. The next question is Rod. I have selected this question from March June 19 attempt, and again it focuses on losses as well as basis period, and some other topics are, let's read the requirements and have an idea. Calculate Rod's after tax proceeds from the sale of shares in LPLC and explain your calculation, the base cost of the shares. Okay, guys, thanks for reminding me for sharing the screen. I have now shared the screen. I hope everybody can view my screen now. Okay, thank you. So moving on, calculate Rod's after-tax proceeds from the sale of his shares in LPLC and explain your calculation of the base cost for the shares. That's for 6 marks. Calculate Rod's share of tax-adjusted trading loss in T partnership for the tax year 2021-22. Third requirement is state how Rod is able to relieve the trading losses calculated in B1, that is in the part above, as early as possible and explain with supporting calculations. Again, we have to explain with supporting calculations the total amount of income tax saved if Rod follows the strategy that we'll be telling in the question. Now, moving on, let's read the introduction. Rod has requested advice in relation to CGT of selling shares he obtained through employer's EMI scheme. So we have to revise EMI scheme and the potential income tax relief available in respect of his share of trading loss of a partnership which he has recently joined. Okay, so he has joined a partnership recently which had made a loss. So we have to tell the treatment of that along with the shares of EMI scheme. Before moving on to the question, let me quickly revise EMI scheme with you. It's in the income tax part of the syllabus. Enterprise Management Incentive Scheme. Obviously, it is one of the approved share option schemes of HMRC. So do remember from that table that I've told you that if your scheme is approved, there are no tax implications on grant date, but there are no tax implications on the exercise date as well, except only one scenario that is only applicable to EMI. What is that scenario? That scenario is if the option is uh, uh, provided to you at a discount. So if the option is provided to you at a discount, only then there will be a income tax and INIC applicable to an approved scheme as well. Whereas normally, if your scheme is approved, there are no tax implications on grant date as well. So do remember, if you have been provided the option at a discount on the grant date. Grant date is obviously the date on which only the promise is being made. Exercise date is the date on which the promises actually gets fulfilled, and the disposal date is the date on which you disposes the shares. So only then the IT and NIC will be applicable, and IT and NIC will be applicable on market value at the grant date less exercise price. Market value on the grant date is obviously the date on which the promise is being made. Exercise price is the price on which you are allowed to actually buy the share on the date on which the promise is being fulfilled, which we call the exercise date. So let's see the question. Let me give you a hint. Examiner has tested this exception of share option scheme in this question. So that is why I have taught you before reading the question. So, Rod is a resident and domiciled in the UK, was employed for many years by LPLC before taking an early retirement on 30th June and joined the T partnership on 1st December 2020. The date is very important. He has joined the partnership on this date. Made no disposals for CGT in the tax year 2021. The examiner is clearly providing you the hint that complete annual exemption is available. Please don't forget that. Other than the sale of shares in LPLC as detailed below. In May 2016, LPLC granted Rod options to purchase 20,000 shares. So the number of shares are very important. Do remember that the shares are 20,000 in its under its EMI scheme. The market value of the share at the grant date was 2.6. If the company will provide him on 2.6, that is fine. No tax implications on the exercise date as well. But if the company will provide him on the discount on the grant date, then there will be IT and NIC. So, and the option price was 2.3 per share. So the market value on which the promise was being made was 2.6, but the company has promised to give him the shares on 2.3. So the obviously company has promised him at a lesser price. So as I just taught you, I'll take you to the notes before. Market value at the grant date less exercise price will subject to IT and NIC, which in our example is 2.6 less 2.3. So that is 2.6 less 2.3. It's 0.3 times 20,000 shares. It's 6,000. It will be subject to IT and NIC. So considering him a higher rate band pair, do remember it will be 42%. 2520 will be the ITNIC. Now, Rod sold all the shares. Rod exercised all of the option on 1st June 2020 when the market value was 3.9. Now this price doesn't matter here. Why? Because there are no implications on the exercise date for the approved scheme except EMI, and in that only you take the market value on the grant date and the exercise price. So the market value at exercise date does not have any use in this question. Rod sold all the shares on 1st December when the market value was 4 per share. The gain is eligible for BADR. Even if the question is not mentioned, do remember that EMI gains are subject to BADR anyways. And let me tell you one very, very important criteria. Normally, if you want to claim BADR on shares, there are two conditions. You need to be employee of the company and you must have 5% holding as well. In EMI, even if you don't have the 5% holding of the company, you still get the BADR. You will be employee, obviously, that is why you are being granted the share options. But even if you are not, even you do not have the 5% holding, you still get the BADR. So that is a very important point to remember, that even if it has not been mentioned, you have to remember that whenever one sells the share of EMI scheme, BADR is automatically available. Okay, do remember that. Now, if I check that what is the gain, let me first calculate the proceeds of that person. So I'll open the spreadsheet. So my proceeds are one share for 4 when he sell the shares. I guess he had 20,000 shares if I'm not wrong. I'll confirm from the question. Yes, 20,000 shares. So 4 times 20,000, 80,000 are my proceeds. What will be my cost? My cost will be exercise price plus if there is any cost on which I have already paid IT and NIC. So I have taken the shares from the company on 2.3 per share. And the difference between 2.6 to 2.3, I have already paid income tax and NIC on that. So now I will not take 2.3 as my cost. I will rather take 2.6, or the other way, or the easier way to understand is, let's say you have to take the cost as 2.3 because this is the price you have paid for the shares for 20,000 shares. It will be 46,000. But do remember, you have already paid income tax and NIC on gain of 30 pence on each share. So that is why this will now not subject to CGT, and that is 0.3 into 20,000, 6,000. Consider if I haven't taken this, you would have to pay 6,000 more tax on the gain. HMRC will not be charging you additional tax because they have already charged you the income tax and NEC between the difference of 2.3 and 2.6. So your gain will be this minus these two figures. 28,000 will be your gain. It was clearly mentioned in the question that I haven't made any other disposals, meaning I have my complete annual exemption left. So my taxable gain will be this figure less this figure, and as it is a gain that is subject to BADR, so CGT will be at the rate of 10%. So this times 10% equals to 1570, and my after tax proceeds will be my proceeds less tax. This will be my after tax proceeds, guys. Let me zoom the window and go through the calculations with you again. The proceeds were pretty easy. It was mentioned in the question that he will sell the shares when the price will be £4 per share. So 4 into 20,000 is 80,000. He has bought the shares from the company on 2.3 per share times 20,000 equals to 46,000. That was his cost. However, HMRC is also HMRC has charged him for the income tax and NIC between the gain of 2.3 and 2.6, that is 0.3. So I will add that 6,000 into my cost, so it will not get charged again in CGT. So my gain is 28,000 after adding these two as a cost, deducting it from my proceeds. My gain is 28,000, deducted my annual exemptions, and all of my gain will subject to 10% CGT because the availability of BADR, and these are my after tax proceeds. I know it was a bit tricky part. If anybody has any questions before I move on to any other part, I would like to answer the questions first. There will be no description, Yusuf. If you will write 0.3 times 20,000, the examiner will understand that obviously you are trying to add this thing as a cost here because you mentioned in the previous part that this will be subject to ITNIC. Ravi, if you have missed the reduction, obviously, if you go through the marking scheme, the examiner has clearly stated that for which part, how many marks he has allocated. In my opinion, he must have allocated 1 to 2 marks for that part. But do remember, The students who must have passed the paper in this attempt might not have attempted every question 100% right. It doesn't matter that every bit should be right. What matters is the majority of the question or your workings or your answer should be correct rather than 100% correction. Uh, I will try to go through the marking scheme with you guys for the question if the time is available. I'll try to go through the marking scheme of this question with you if the time is left, but I will recommend if I was unable to, you can quickly download the past paper because the attempt has been mentioned and check the marking scheme, or go on to the answer of this question from the Kaplan revision kit, and at the very end you will find the marking scheme there. Okay guys, so that was the most tricky part. Moving on to the other requirements about the partnership losses. Let's read the scenario. The partnership has been carried on for many years by two partners, Abby and Bob. Prepares accounts for 30th November annually. I was entered into the partnership for 1st December, and in my very first year, the partnership start making loss. So the loss was 47,000 in total. I have to check what is the partnership sharing ratio to check that what amount of loss A will be allocated to me. The partnership sharing ratio from 1st December is as follows. Annual salaries are this, and before the salaries, the loss is 47,000. Plus 20 and 20 salaries of Abby and Bob will be 80,000. So I guess the loss will be 87,000. Because 20,000 times 2, salary of two partners, plus 47,000. Salary is an expense for partnership, so it will further increase the loss to 87,000. Now this loss will be shared between all three partners equally. Rod is not getting any salary, so I haven't added his salary. So if I divide this loss by 3, 29,000 will be the share of Rod. Now, because Rod has entered the partnership and it is his first year, the basis period rule applies, and basis period rule says for the first year, either it is a profit or a loss. You have to take, or you have to time apportion the profit or loss from the date you enter into the business till the coming 5th April. So obviously the Rod has been entered into the business on 1st December 2020. So the next coming 5th April would have been 5th April 2021. And we ignore the 5 days for calculation purposes, and we will consider till 31st March. It becomes 4 months. So we have to time apportion the 29,000 loss, which is for whole year, to 4 months. So I will divide it by 12 and multiply it by 4. I will round it off as 9,667. So 9,667 is the amount of loss that will be available in the first year, first tax year in which he has entered the partnership, and that tax year is 2021. 2021 means that has started in 20 and ended in 2021. So let's write that in our word processor. So loss to claim in 2020/21 is 9,667, and you can quickly tell examiner that you have computed it by 29,000, dividing it by 5, dividing it by 12 and multiplying it by 5. And loss to claim in 21/22. I have to check that whether it has been asked by myself. So I will check the requirements. Yes, I have to tell the losses in 2021 and 21/22. So the next year, the rule says that if a period of account is ending in a tax year, you will take the losses of that period completely. What do I mean by that? Consider a timeline consider a timeline, and for you, I will draw a timeline here. So guys, consider this a timeline. This is April. This is April 20, and this is April. Sorry, this is April 21, and this is April 22. Now, the company prepares accounts for every year for November, 30th November. The first year on which the rod has entered was from 1st December 2020 till 30th November 2021. It will fall in this tax year, November 21, 30th November 2021. If the partnership's year end fall within the tax year and it is for complete 12 months, basis period states you have to copy paste whatever is given into the question. To me, the question says that 29,000 losses have been happened completely in the tax year. But losses cannot overlap. I have already utilized the losses of 9667. So I will not take those losses. Rather, the remaining losses can be remained in the can be claimed in the next year. Out of the 29,000 losses, 9667 have been claimed in the first tax year. Remaining 1933 of the losses can be claimed in the next year. So 1933 are the remaining losses that can be claimed next year. If you still struggle, what you can do is you can visit my notes, and in that I have mentioned an easy table for basis period in the income tax section. That from the first year, the basis period is always from the first day till coming 5th April. That I have done with yourself. In the second year onward, all you have to check, is there a period of account ending in a tax year? If your answer is yes, our was ending on 30th November. You have to check what is its length. If it's 12 months, you have to copy paste whatever is given into your question. If there would have been profits, the profits usually overlap, and you have to pay the tax twice on the same amount of profit, but the losses don't overlap. So that is why I would have pasted 29,000 completely if they would have been profits. But as they were losses, I have deducted 9667 because losses never overlaps. If you still struggles with basis period, I have dedicated day 4 to cover basis period, in which I will cover the basis period in detail with you guys. So coming back to the requirements, I now have to tell how ROD can relieve these losses as early as possible. For that, I have to read the remaining question. These are the ROD's income from 2017-18 to 2021. Now, if the examiner has given you incomes of one's previous years, it is a hint that he's trying to tell you to think about carry back loss relief. Why he has given us the incomes of previous years rather than future years? Because he wants to think us that is there any relief available for previous years? And yes, in my notes you will find under the trading loss section that there is a loss relief called earlier year loss relief. Opening an earlier year loss relief. It says that if you start any business and in the very first 3 years of the business, you came across losses, you can, rather than carry forward, carry back them. Carry back relief is normally available as well, but only for 1 year. But in opening year loss relief, carry back is available for 3 years. So you can carry back your loss in previous 3 years under the FIFO basis, which means the oldest one first. If I come on to the question, he has suffered the loss first in 2021. Okay, so first he has the incomes available in the same year, employment income of 26,000 and 8,000 dividends. So he can relieve the losses here first. For example, the losses of 9667 could have been immediately relieved here. And considering he is a basic rate band payer, I could have said that he would have saved 20% tax on that. So this would have been the tax savings. Now in the next year, 21-22, he has suffered losses of 19,333, which I have calculated with you here. He can carry it back on the FIFO basis in previous 3 years. So this one is the latest one, this one is the older, this one is the oldest one. So in this year, he can relieve the losses, and I can clearly see that he is a high rate band payer in this tax year. So you can tell examiner that he can make 40% tax savings on this process. Now let me tell you a very interesting point. If you do not know how to calculate losses using the basis period and you have calculated the losses wrongly, but you have suggested whatever your amount of losses are, wrongly calculated losses, you have suggested correctly that earlier year income loss relief is available here, and first the loss will be relief against this year, and then he can claim the earlier year loss relief with the oldest year first. You could have scored full marks. The only marks the examiner will deduct will the amount of losses that you have calculated first, but the remaining marks you'll be able to score. So guys, with that, I have covered all the requirements of this question as well. I will dedicate last 3-4 minutes to your questions. If you have any questions, please do ask in the question section. Sayed, I have used 4 months rather than 5, I guess. The losses were 29,000 divided it by 12 times 4. Yes, I have taken 4 months. 9667 was my answer. Any other question, guys, on this topic? Okay guys, I've tried to explain in an easiest way as I can. I hope this will be useful for you. If anybody has missed any part of this, recordings will be available on the very next day. It takes usually 1 day for ACCA to upload the recorded session. So you have to bear with us for 1 day. But in the very next day, the recording of last day will be available. And after the end of the 5 days, recording of all 5 days will be available on ACCA's Vimeo channel, and you can visit this and take these lectures as per your convenience. Junaid, there are no specific topics that I choose. I usually try to cover every tax daily, be it income tax, be it corporation, VAT. So obviously there are no specific topics, but I have selected certain topics for tomorrow as well. So with that, I hope to see all of you tomorrow as well. I hope all of you are finding this session useful. So do remember me in your prayers, and inshallah I'll meet you tomorrow. With that, I would like to sign off. See you tomorrow. Bye bye.